Hey everyone, hope you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter, see what people are sharing on social media, generally related to three different topics: wealth building, commodities, and/or financial topics. We'll dive right in, take a look, see what's going on, and I'll share my opinions. If you want to follow me at Finance, and if you want to join our community, findinghypervalue.com, where I dive deeper into all these topics, looking for potential investors. I go over those opportunities and the fundamentals sometimes with everyone on the website. So if you're interested in finding more companies to potentially invest in, the ones that I like the best for this commodity bull market that we are in, definitely give it a try. We do have that special quote coupon code. It is special. That's the name of the coupon code. If you'd like a larger discount. So Cuppy, it says, does your data set include periods where Ponzi's and Mag 20 suck all of the capital out of every other CU SIP? It says, arguably the two most washed out ETFs among the hundreds I follow are Materials and Brazil EWZ. That's from that strong dollar. Anything that's dollar related, everything's getting sucked into the dollar stuff. Because over the past 20 years, they essentially have a 100% win rate if holding for 1 year. Both also tend to move inverse to the dollar, so there's that. So what does that mean? So every time you've purchased at these areas where the red dot is at, 12 months later, on every single one, you would have made money in these potential purchase areas. Will that continue? I don't know, but that's what he's looking at. And this is all. This is the which one is this one? That was Materials. This is EWZ, even though I don't see the ticker on it. Look at all the red down here where it's really, really low. We just entered that really low portion in EWZ. So good time to be looking, doing your research amongst Materials and Brazil, as this is way out of favor. Coming on back. TI. So this is his opinion. Let's see what it is. It says crude oil closed the week above 20-week moving average. Top is just around the corner as it's approaching the next 13, 14-week cycle high, in his opinion. The target is the upper Bollinger Band. In the greater scheme of things, it's just another lower high in a long-term downtrend, in his opinion. So let's go see. This is his response. The Trump administration is going to ramp up production. I don't know about OPEC. Really? And the companies, if you listen to their quarterly earnings conference calls, makes this guy look like he has no idea what he's talking about. Cycles fans. They're not going to ramp production. One person company, I'm not going to name the drilling company, and they almost started laughing on the conference call. it's it's so funny. They're like Trump has no impact whether we drill or we don't. It's all based off of the economics, was their answer in the conference call that I was listening to. Now I listened to, I don't know, maybe 20 to 30 conference calls, maybe more, across the board of commodities, energy service, the exploration production companies. I listened to a lot of those. I listened to some of the other shipping companies, tanker companies, um, and across the boards of some of the miners too. So I'm mainly in energy. I like energy the most, just because that's where the money is going to be made, I think. But that's a opposing viewpoint, and the narrative behind the opposing viewpoint. Um, I would say that's a pretty weak argument, in my opinion. People can disagree, and I'm fine with people disagreeing with my viewpoint or whatever, but at least have a good argument. At least come out with something. My argument, if you want to know what my argument is for the long side, we are at a very cheap ratio. So historically, it's the second cheapest time in history, going back to 1800s. We are low on inventory. The fair value based off of the dot plot of commercial inventories is about $85 to $87 a barrel. We are low in the strategic petroleum reserves, and they flooded the market trying to hold this thing down. So it's not like we are stacking a bunch of strategic petroleum reserves. The Duke inventory is low. That's drilled uncompleted wells, and I see a lot of positive technical development in a lot of individual companies of falling wedges and stuff. Now, does that mean it has to go higher? No, it doesn't mean it has to go higher. If there's a slowdown in the market, we definitely could go lower. But right now, what we're seeing, it looks decent, and we'll see if we get the follow through. That's all I'll say. Borovic says Saylor says he will burn his BTC keys after he passes so that no one can ever sell his Bitcoin. If that is true, that would actually support my view on Bitcoin, where Bitcoin will eventually die in all dead people's accounts. And I was kind of joking about that to some degree. I was only partially joking, but this kind of solidifies that if he actually does do that. And I have no idea if this is being serious or not. This one here, I put existing home inventory. I got it wrong. It's U.S. new single family months of remaining inventory, um, which is down here in 2012. But this is the history of it, around 6 months or so. And then we went up during these areas here for new single family months of remaining inventory. This here is existing homes, November of 2024. The inventory of existing homes was 3.8 months of supply, which was lower than the 4.2 months supply in October. However, the number of homes available for sale is almost 27% higher than it was at the end of 2023. I did go in and post some more data here. So this is the total single family months of supply, combined new and existing homes. So if we look back in history, in the early 80s, we were at about 10 months of supply, which is pretty dang high. This is generally when prices start to um, lose their firmness, is what I'll call it. We squeezed up in the late 90s, early 2000s for a big bull market, which existed in the 2000s. We peaked out in 2007, 8, rolled on over. And right now, we're at really low inventory. So this is all in response to someone else posting some stuff later on. Low inventory, existing and new. If you were to break those two up, you can see that existing homes are down here at about 3.8 months, which is historically incredibly cheap. It is the cheapest it's been going back to 1983 in terms of, I'm not the cheapest, but the lowest inventory that it's been going back to 1983. The new homes month supply is about 9. And what's occurring is that the existing homes are so low that people are going to buy new homes. What they've been doing to sell the homes is they've been buying down the mortgage interest rate for the buyers. The home builders have been. And they've been moving inventory by doing that trick with affordability, so to speak. Since interest rates have gone up recently, we could see a slowing of that new build selling working like that because the affordability, even with the rate buy downs, could be not enough for the buyers. But I also think that we're not going to have a crash. The reason I don't think we're going to have a crash is because existing inventory is so low. On top of that, the home builders can obviously pull back on producing new homes. So that is another thing that they can do, and that would obviously be a slowdown in the market. We have a bunch of buyers, but affordability is the problem. So we've got buyers that are all located underneath the pricing and affordability that it is today. So this isn't like we can just crash and burn because if we start to slow down, I have a feeling they're going to lower interest rates, which then increases the affordability. And there's buyers down there when you increase the affordability. Here is the dot plot. So this is total months supply and home price growth. If you look at 6 months, which is right here, we hardly have any negative numbers with 6 months or less supply. We've got a couple here that showed up in 2022, I think, or somewhere around there. But for the most part, if you're underneath 6 months, you have positive price appreciation or growth. This is year over year home price growth, and it's almost all positive in this quadrant of 6 months and lower. If we have existing inventory at 3.8 months, which is basically this right here, and these are some of the dots that are showing up, affordability is having an impact, which is actually a few standard deviations from where we should be appreciating. Given our existing inventory level, we should be appreciating at close to 10%, between 8 and 10% up here. So that would be a normal market of homes going up between 8 and 10% given our inventory level historically. Coming back, we've got Caleb Thomas. He says something happened in 2009. European equities used to be good, more or less stocks, but something changed in 2009. One issue was that hangover from the credit boom, with rolling sovereign debt crisis and structurally lower growth as it digested malinvestment and deleveraging. On the other hand, saw years of easy policy and struck tech stock oil. This is kind of interesting. Look at 89 to 2009 and how well these tracked each other. And then when you look at 2009 to present, US just ripped and Euro stocks have vastly underperformed. I don't know if this is a demographic issue or something to do with the policies that Europe is implementing. It's tough to say. At least for me, it's tough for me to understand because I don't know what's causing this large divergence. And I'm sure a lot of people have a lot of opinions about it. But it's interesting to see. Hinster, URNM, fundamentals and technicals are screaming a buy. My best probability investment is URNM. We had a consolidation here into the buy zone of the uptrend line. We came on up and ripped. We had another consolidation and we're still above the uptrend line. And we could see another rip again to the upside. And this is the Sprott Uranium Miners ETF, URNM. SWU is at 195 new record high, and that's generally what uranium follows, is the SWU price, which is the enriched uranium that comes in front of the in front of uranium. Conversion 97 all-time high, and then long-term contracts U308 is $82, which is a 16-year high. So everything looks good. Everything looks good for uranium in terms of the fundamentals and the pricing and the way it's moving. Be patient, everyone. Be patient. What does well under high inflation? Long commodities, short long-term bonds as inflation rises. Correlation of real and financial assets with inflation since 1950, and real assets go up 73%. Commodities, platinum is up there, real estate, diamonds, gold, collectibles. Now, have we gotten a lot of inflation? Because platinum hasn't really taken off yet. And maybe that inflation is working its way through the system. You can also use ratios. You can use ratios like platinum divided by gold. And when that goes up, you know that you're in an inflationary regime. I know that the stock market, there was some people, I think it was Yale, that did a study of platinum to gold ratio. When the platinum to gold ratio declines, the stock market does really well. When platinum outperforms gold, that's when the stock market underperforms. And that's when we see the big commodity bull market. So platinum is squeezing up. It may take a little bit more time to consolidate, but that's something to watch in terms of that ratio. How successful are traders? And this is from Tradecity. So let's go from the bottom up. All traders start with the dream to get rich quick. 40% trade only for 1 month. 80% quit within the first 2 years. Only 7% remain after 5 years. And only 1% of all traders can profit net of fees. 1% of all traders can even make a profit net of fees. Yeah, let's do some trading. Let's get rich quick. Let's go do some FOMO into some crypto and trade some crypto. 1% of all traders can profit net of fees. US affordability is a crisis. So the median annual house payment has hit 39.4%, the most since 1980s. The rate has skyrocketed by 14 percentage points in 2020 and has surpassed the 2006 housing bubble peak of 38.1. It is now only below the 47.5% record set in 1981 when mortgage rates were as high as 18%. Meanwhile, the average rate on a 30-year mortgage has risen by 100 basis points since September to 7.1%, near the highest since July. Buying a house has rarely ever been so expensive. And this is what they have. They've got 18% mortgage rates, housing bubble 1, and they've got housing bubble 2. But here's my question. We went over existing inventory of 3.8 months. The dot plot of 3.8 months has never been negative, but we're in a housing bubble. How? Because of the affordability is what they'll say. But we don't have the inventory. So where is the inventory going to come from? That is my question. HZ says the U.S. 10-year, 2-year spread breaking above zero in 2024 mirrors historic pre-crash signals from 2000 and 2007. This steepening marks a shift that could cement 2025 and 2026 as one for the history books, in his opinion. So in his opinion, he says that we could potentially have a slowdown, and it's solely based on the 10 and 2 spread breaking above zero. Now, historically, that has resulted in recessions, and that very well could result in a recession. So should we position a portfolio based off of this information? So Warren Pies, he says the 2025 outlook, in his opinion, 2025 is a mid-cycle year, which doesn't match this. He says this means the economy is not entering a recession, late cycle equals red, or emerging from a recession, early cycle yellow. He says in mid-cycle years, the S&P 500 returns are higher and drawdowns shallower, especially when the Fed is not hiking. Wait. So how can this be? How can one person say that we are going to have one for the history books in 25 and 26, but Warren Pye says we're in a mid-cycle year and we're not even late cycle, and we're not early cycle? My question is, didn't we have a recession, 2 negative GDP quarters back in 2022? And didn't they just change the way that they are recording it and measuring it? If that's the case, we already went through a recession, right? So how could we not be an early cycle yellow if we just went through one in 2022? And according to this, we're late cycle and red to HZ. So how come we're not late cycle then? In basically coming into a recession. See the difference there? See what makes this so difficult for most people to make ends out of? Everyone's got conflicting information, and they might have the same information, but they're all coming to conclusions that conflict with each other. Reads with Ravi says, a man who is a master of patience is a master of everything else. Makes sense. Casper says the 45-year cup and handle setup for silver points to $650 with potential overperformance. Might as well go big. $650, that's a big move. So what could cause that? What could cause, well, we've got a 45-year cup and handle pattern. That's what he's using. He's looking backwards to project the future, which I do too, to some degree. The fractal is the genetics of the market. Now, $650, that's a big move. Well, that to me sounds like we either encounter a major shortage of silver on the supply side, or demand goes up while we encounter that supply shortage, and or demand just rips and we have an inflationary problem or a bond market problem or some problem in the financial markets which causes a whole bunch of money to shift and move, which could also be an outcome. Time frame unknown. Ian Castle says stock picking means finding businesses today that other investors will like more than a year later. They're going to like more than you a year later. So you're finding stocks that are cheap, and then you're selling it to people that are willing to pay more money for them a year, 2 years, 3 years, whatever, some time frame later. Mike Zaccardi says ISM manufacturing tends to lead the S&P 500. PS growth rates by roughly 4 months. So it leads. So what do we have here? ISM manufacturing PMI is the light colored gray line, and then the dark blue line is the S&P 500. And we are heading higher. That's what we're showing in the ISM here the past few months. Is the S&P going to move up higher? If this is negative here, we are actually in a recession for PMI or ISM manufacturing. That started in 2022 and into 2023. So the S&P 500 and the economy diverted to some degree recently. So are we going to move up in ISM? Are we in a recession? Are they just going to like print money and paper over the recession and understate inflation, overstate GDP? Yeah, that's probably what they're doing. That's my guess. But this here, it's getting a little bit better, but it still looks like we're shrinking and below 50 in the ISM manufacturing. Gasoline with a serious breakout, as discussed with myself this past week. 2025 could be a major year for energy, oil, gas, and uranium. So gasoline is breaking to the upside. I thought that the guy above that crude oil was going to go down, but why is gasoline breaking to the upside? I thought we were in bearish mode. Well, this looks bullish to me. I don't know. It looks good. That's how I would play it at least. Warren Buffett says we look to business performance, not market performance. If we are correct in expectations regarding the business, the market will eventually follow along. So look at the business performance, and the stock price will follow. Don't worry about market performance. That's not what you should be measuring. Be measuring business performance. The U.S. consumer is amazingly resilient. 2024 auto sales were the highest in 5 years, despite higher interest rates and more challenging economy. People can't afford to buy a house, but they'll buy cars all day long. Where is all this money coming from? The U.S. new car sales rose to 5-year high in 2024, helped by hybrids. And that sounds interesting. I thought we were going to go into recession and the yield curve was uninverting. What's going on here? What is going on here? The macro picture is a difficult one. But what about copper here? Feeling under the weather? Go see Dr. Copper. Shoulder, head, shoulder. I know we've gotten a little bit of selling pressure recently. Can this go back up? I don't know. We'll find out. If Dr. Copper starts going up and this is a shoulder, head, shoulder, and we break out, maybe we're not in a recession. Tough. I know it's tough. The only chart you need to understand macroeconomics and personal finance for the next 30 years. What is this? This is gross federal debt as percent of gross domestic product, which is this on the left. And then on the right, the 3-month treasury bill secondary market rate, discount rate, which is skyrocketing. That's going to skyrocket our gross federal debt. It's a tough situation they're in. They're trying to inflate their way out of it. That's all I've got for today, guys. So give me a thumb up for the content. Subscribe to the channel. Subscribe to the website. We'll catch you guys later. This is Finding Value.